Hello and welcome to part 1 of the chapter 3 videos where we will be discussing cost volume profit analysis in detail. So we're primarily going to cover or a high level overview of cost volume profit analysis in this video. And in the second video, we'll talk about cost structures and margin of safety. And in the third video, we'll talk about extensions of cost volume profit analysis, specifically looking at tax situations and multi-product situations. We'll also talk about some of the assumptions. So cost volume profit analysis is the same concept that you learned in accounting too, where we're looking at break even. We're looking at things like margin of safety. How many units do we need to sell in order to make a certain amount of profit? How many units do we need to sell to at least cover all of our costs? So cost volume profit analysis is just an analysis that looks at the relationships between revenues, all of our costs, and the number of units that we sell and the impact those relationships will have on profits. We can do this analysis by looking at the contribution margin income statement over and over again. We can do calculations using different formulas, or we can even do a graphic presentation for this particular analysis. So don't let CVP analysis, don't let the name intimidate you. It's essentially break-even analysis. We're trying to discover how many units do we need to sell in order to cover our costs. Now, one of the ways we can do this, as I mentioned, is the equation method. And this requires us to look at the profit equation. If you look at the income statement, you'll notice that we're taking all of our revenues and we're subtracting all of our costs, and that gives us our profit. We can use this same formula to help us determine what our revenue should be in order to obtain a certain amount of profit. Or if we change our costs, what type of impact would that have on our revenues and our profits if we want to maintain the same level of profits? So this is just the different ways that we can express the items in the profit equation. So in looking at revenue, we can find a formula for revenue by taking the selling price times the number of units produced and sold. And for costs, keep in mind that costs have two components, variable and fixed. You receive the foundation for this chapter in chapter 2 when we looked at the contribution margin income statement. So we're really focused on separating costs or identifying costs by behavior, variable versus fixed. So our two components are our variable costs and our fixed costs. For our variable costs, it's a little more work. We have to take that variable cost per unit and then multiply it times the number of units that we sold. And then for fixed costs, then we'll add that in to our variable costs to get our total cost. So we can sort of shift things around, and in order to find our break-even point or how many units we need to sell to at least cover our costs, we can set profits equal to 0. So this price minus variable costs, and then we can multiply that times the units of output. This represents our contribution margin. Remember, sales minus variable cost is contribution margin. So if I take my contribution margin and I multiply it times the number of units that I sell, and I subtract out my fixed cost, then I can find profit. We're just kind of shifting things around. So again, contribution margin, this is a recap for you. It's the difference between my sales price and my variable cost. It represents what I have left over after I cover my variable costs to cover my fixed costs and to make a profit. And it's important to evaluate or make decisions in this way because variable costs, I have a little more control over them. If I sell more units, then of course my variable costs are going to go up. If I sell fewer units, my variable costs are going to go down. But my fixed costs will be there even if I have 0 sales. So when I need to make decisions, it's easier for me to make good decisions when I look at costs in terms of what I can control and what I cannot control. So here's an example. This is a contribution margin income statement. You are a professional at preparing these statements at this point because you've done it several times. We take our sales minus all of our variable costs. Now here you can see variable costs are separated between our production costs and our period costs, and that's okay, but we're still grouping them together in total to find that contribution margin. Then we subtract out all of our fixed costs, and that gives us our operating profits. We can express contribution margin in terms of dollars, as you see here, that 28,880, in terms of a percentage, or we can even express it in terms of a per unit amount. We're going to see contribution margin expressed in a couple of different ways, and it's really going to help us analyze when we look at this cost volume profit example. So let's jump to break even, because break even is just a component of CVP analysis. For break even, we can use the long way, which is the equation method, not my favorite method to use. Sometimes it can be confusing in terms of remembering what all these different variables mean. But when we use this way, we're setting profit equal to 0. I like to use the formula method, where we take fixed cost and we divide it by contribution margin per unit. When we do this, this will tell us how many units we need to sell in order to have 0 profits. I could take this information and plug it into a contribution margin income statement, and I would demonstrate and prove that profits equal 0. At the break-even point, the contribution margin should be, in dollars, should be equal to my fixed cost. Let me jump back for a second and show you what I mean. So keep in mind that at the break-even point, profits are 0. When profits are 0, that means my contribution margin and my fixed costs have to be the same, because contribution margin minus fixed costs give me profits. So if my fixed costs are 28,880, then my profits are 0. That's why I can create this formula here, where I'm taking fixed costs and I'm dividing it by the unit contribution margin, and that will give me my break even in terms of units. Now, just like contribution margin can be expressed in terms of dollars or units, I can also express break even in terms of dollars or units. If I want to find break even in terms of units, then I have to use the contribution margin per unit. If I want to find break even in terms of dollars, I have to use the contribution margin ratio. Now, there's more than one way to find the right answer here when we're looking at break even. If I have break even in terms of units, I can take those units and multiply it times my sales price per unit, and that's still going to give me break even in terms of dollars. Or I can do it the long way and use the contribution margin ratio. Doesn't matter which way you do it, as long as you actually do it. Now, the contribution margin ratio is found by taking the contribution margin and dividing it by sales. Just make sure that you're comparing apples with apples and oranges with oranges. So if you're using the contribution margin per unit and you want to find the contribution margin ratio, or that percentage, then you have to divide it by sales per unit, like we did here. We could also take contribution margin in dollars and divide it by sales in dollars, and we could still find that contribution margin ratio, or that percentage. Once you find that percentage, it does become the denominator in my formula to help me find break even in terms of dollars. So I'm still taking my fixed cost and I'm dividing it by contribution margin. It just depends on whether I need contribution margin per unit for break even in units, or contribution margin ratio, or the percentage, for break even in dollars. Now we can extend this further, because we're in business to make a profit. It's good that we can cover our costs. That's great. But what if I want to make a certain amount of profit and I already have that number in mind? What if I want to cover all my costs? I want to make $2,000 in profit. How many units do I need to sell? Well, of course, that answer is going to be different from my break-even calculation. In fact, I would expect that to be more, because I would need to sell more in order to have more money left over. So we can change the break-even formula, and instead of taking fixed cost divided by contribution margin, I can now take fixed costs plus my target profit, and that's the profit that I want to be able to make. I can take that, and the combination of those two numbers will now be my numerator, and then divide that by my contribution margin, to find how many units I need to sell in order to have $1,800 in profit. Now, this slide here is showing you this calculation in terms of units and in terms of dollars. Notice that we are using the contribution margin per unit, so that's that price per unit, in order to find it in units, or we're using the ratio to find the target profit in dollars. Now, these formulas, pretty straightforward. I would say as you are working on the assignments, use these formulas as a guide. We're essentially doing the same thing over and over again. Fixed cost is my numerator or a part of my numerator, whether I'm finding break even or whether I'm trying to find a certain amount of profit or target profit. We take our fixed cost and we divide it by contribution margin. Notice the contribution margin is consistently seen throughout all of my formulas. It just depends on what I am trying to find in terms of my final answer. If I want my answer to be in units, I need my contribution margin per unit. So fixed cost divided by unit contribution margin. If I want my final answer to be in dollars, then I need the contribution margin ratio. Got to use my decimal or my percentage. So fixed cost divided by the contribution margin ratio gives me break even. And then with target profit, or this book likes to call it target volume. I think in accounting 2, your book likes to call it target profit. It's the same thing. We're still trying to find out how many units we need to sell in order to make a certain amount of profit, or how much money do we need to have in sales to make a certain amount of profit. Just add that profit, that desired profit, into your fixed costs in your numerator and make sure you're dividing by the correct denominator. Now, let's look at this in graph form. I won't have you prepare a graph, but I do want you to understand this, because when you get out in the real world, executives like to see pictures. They want to see it in graph format. That way, you want to see it with different colors, different lines, so that they can have a visual representation of what their profits are going to be. So in this graph, on the x-axis, X is my activity. And in this case, X is the number of units that we want to sell. My Y would be my dollars. Sometimes those dollars are revenues, sometimes those dollars are costs, but dollars nonetheless. Now I have 2 lines here. One line represents my total cost line, and one line represents my total revenue line. How can I tell the difference between the two? Well, for total revenue, and that's my dash line here, I know that this is my total revenue line because when I sell no units, I make no money, so I have no revenue. So I'm starting off at 0, 0. And notice that we continue to move up on this line as we sell more units. It makes more sense. The more units I sell, the more revenues I'm going to have. Now, for my cost line, remember that total cost has 2 components, a variable component and a fixed component. With the fixed component, even when I sell no units, I still have my fixed costs. And if we remember, let me go back for a second. Let's see, my fixed costs were $1,500. So when we sell no units, we still have $1,500 in costs. Now, as we start to sell units, my variable costs start to kick in. So notice that that total cost line continues to increase. At the point where my revenue line intersects with my cost line, and this line is a little bit off here, that point represents my break-even point. And I know that this is my break-even point because look, at this point, my costs exceed my revenues. See how my cost line is above my revenues? And then at some point we come together and my revenues exceed my costs. So this area down here, I would shade this, and this would be my loss area. So I know that if I only sell 2,000 units, I'm going to be at a loss. It's not going to be enough to cover all of my costs. This area above the point of intersection is my profit area. Remember, we calculated break even in terms of units to be 6250. So this dashed line should really be moved over a little bit more because that's more in line with 6250. Once I sell 6250, I'm done covering my costs and I can start to make a profit. So we can take this break even analysis information and we can show it in a graph form so that we can get a quick glance where my profit area is, where my loss area is, and where I need to be in terms of my break even point. Now, that takes care of this video where I gave you a high level overview of cost volume profit analysis. Join me in the next video where we're going to talk about cost structure and margin of safety and extend this cost volume profit analysis discussion even further. Thank you for your time and attention. I hope you have a great day.